Hello everyone. So in this video, I will discuss with you risk and return. They are the two most important concepts in finance. They are complicated. And in this video, I will discuss with you the fundamental and try to give you the kind of visual image of how risk and return look like. Sound a little bit weird, right? So, okay, I will show you how they look like. I will show you total return, the total risk, and then I show you how it works in practice. I will show you and then I will classify them into systematic risk and non-systematic risk. And finally, I show you why non-systematic risk can be diversified away. Okay, so being said that, how risk and return look like. So assuming that we invest in a stocks, and today here's where we invest. The price is say $1, right? And now after a year, 1 year, okay, the price turned into say $20. So 20 times growth. It's so impressive for 1 year, right? Now, in terms of return, all you need is a starting point and the ending point, and you can tell the return right away. Okay, I make a lot of money during that 1 year. So, okay, now if the price of your stocks moving like that, does it look good for you? Yeah, I mean it grow gradually from 1 to 20. It look awesome. Okay, another stock also move from 1 to 20 within 1 year. Okay, however, the movement is like that. Okay, in terms of return, invest 1, get 20. Both of them are equally good. However, in terms of the way the stock price move, which stock you feel better? Which stock you feel better? Or like if I add another stock but moving like that, yeah. So which one you prefer? I believe that you and me should prefer the blue line because there is not much kind of volatility, not much unexpected movement in the stock price, right? On the other hand, the red and the orange, I mean, we should have a heart attack along the way. Yeah, it is look like a roller coaster. Now, so again, for the return, you only pay attention. All you need is the beginning and the ending point. When you look at the shape or the movement of the price over time, you like one shape than the other. Now we are talking about risk. The risk refers to the volatility. Okay, the more unexpected movement, the larger the unexpected movement, the more risk a stock is. Okay, and later on I will show you that the risk can be measured by the standard deviation. And what we see over here, what we discussed so far, is the total risk for a given stock, right? It is total, all in all kind of risk taking account for, okay? So it is the kind of theoretical example. Now let's look at the reality. Over here, I prepare few stock for you. First of all, it is a market in general. So here is a chart for the S&P 500 from the late 2009 to 2014. You see that the price of S&P grow from like 1100 in 2010 all the way to 2000 or 1900 recently, right? It's a market in general. Now, if you look at like Walmart during the same period of time, you see it also growing, but guess what? It's kind of similar, not 100%, but kind of similar. Now, let's look at the different situation like Apple. Okay, the shape totally different, right? So it means the shape here tell you how risky individual series or individual stocks. If you want to compare them, you may want to put them all in one chart. Here's a market. Let me add Apple in. Okay, so Apple is a red graph, and market in general, S&P 500 is blue. What I can take from this slide is that Apple is way more risky than S&P 500. And guess what? As a kind of old say in finance, the higher the risk, you should expect higher return, or in short, higher the risk, higher expected return. Okay, it is. Now, if you add, say, Walmart in, you see, the Walmart is a risk kind of similar to the market, right? And therefore, you see, the return is kind of closer to the market. Yep. Okay. And let me add Bank of America. Now, Bank of America is kind of more volatile than the market. However, the return during that period of 1, 2, 3, about 5 years, it is less than the market. So even though Bank of America is riskier than the S&P 500, it doesn't always mean that you will get higher return. You expect a better return, but the reality may not be like your expectation, right? Yep. Okay. Now where we are. So practice of systematic risk and non-systematic risk. Let me show you. Okay. Let me take off a few of them. Let me leave. Okay, now the total risk is the total volatility of a given stocks. Now in finance, people divide the risk into two components. One is systematic and the other is non-systematic. Now what does this mean? The systematic risk refer to the fact that a stock is affected by the market. How much the stocks is affected by the market is reflected in the systematic risk. If a stock is very much or highly affected by the market movement, we say this stock have high systematic risk. For example, if in a given day or in a given month, the market go up by 1%, and the stock go up also 1%, so it is about 100% match, right? However, if in that situation, if the market move up 1%, and look at Apple, it moved up by like 20%, for example, so it means Apple is heavily influenced by the market condition, and therefore it should have higher systematic risk. Yep. In this case, I can say Apple have very high systematic risk, especially if you look at the period from like middle of 2013 to today. The market kind of going up in a smooth manner, right? However, look at Apple, it just like rocket through the roof, right? So Apple have very high systematic risk. To compare, let's look at Walmart. You see, Walmart is a blue line here. Yes, it is not 100% match with the market, but it's quite close, right? It is quite close. So we may expect Walmart have low systematic risk. Okay. Now, where can we find some measure about systematic risk? How can we find how much the market affect a firm, which is a systematic risk? Google Finance may give you some information over here. If you check for Walmart, okay, you see quite a lot of few kind of financial index or indicator is reported. Here's a beta. Beta is a measure of systematic risk. Yep. Is how closely it moved with the market, or how much it is influenced by the market. So for Walmart, the beta is 0.46, and if you read the book, 0.46 is kind of lower bound, right? Lower bound. Now let's look at Apple. What you expect is it may have higher beta than Walmart, and over here, the beta for that is 0.89. Yep, higher. And of course, what we look and the number reflected over here may not 100% or may not always match each other, but at least it gives you some idea. Okay. finally, okay, non-systematic risk. Now, systematic risk measure how much you are influenced. So what is non-systematic risk? It is the rest of the risk. So the total risk, and within total risk, we have systematic and non-systematic. For example, the movement of a given stock that is have nothing to do with the market. Like even though the market go up for like 1 or 2% over the month, but because of the condition pertaining to this firm, like you have a bad product or you have a recall, so the stock price drop. So this is only belong to this stock itself, and it is a non-systematic risk. So in this table here, I can show you the non-systematic risk. For example, over from like for the last quarter of 2012, the last quarter, the market is kind of flat a little bit, right? Kind of flat. The blue line is flat here. Now look at Apple. It's sharp crash. Yep. I do not know what happened, but something occurred with the firm itself. Like a bad iPhone or something. I'm just making it up. So these have nothing to do with the market, and it is the non-systematic risk. Okay, it is systematic and non-systematic combined. It is total risk, right? Now let me add a Citibank. Now, Bank of America, for example, is clearer. So in a given period, maybe you see here, for example here, for the 2014, the market going up, right? The blue line here going up, but guess what? The green line for Bank of America here, it's going down. So it may be caused by something happened only to Citibank, the problem with only Citibank, so it is non-systematic. Now, in finance, both risks are important, right? When you analyze something, you have to analyze risk all in all. However, think about that. Look at that picture. If you are a portfolio manager and you have a lot of stocks in your portfolio, okay? Do you see anything interesting here? Assuming that you only have like Apple and Bank of America, the red and the green. You see, one is on the upside above the market, on one in the lower side of the market, right? So if you work it hard enough and figure out some kind of magic number, you can have the return on Apple offset for the loss on Bank of America. It means that the individual volatility of a given stock due to the factor within the firm itself, in other words, the non-systematic risk, can cancel each other out. So over here, it is quite clear in that area in the middle of 2013, you see the difference. If you have 50% of Apple and 50% of Bank of America, you can see that your return should be about the blue line, which is a market on average, right? Yep. So in finance, as you read in the later part of this book, they say that only systematic risk matter in portfolio management. If your portfolio include like 20 or so, or more than 25 stocks, now the individual risk will be eliminated or diversified away. So think about that. If you have a lot of stocks in here, you see here, for example, now everything will come closer when you combine. Everything will come closer to the market on average. So it is the idea behind the diversification. Okay, thank you.